because interest is a deductible expense for firms, and a dividend is not, then there's a tax advantage for firms to borrow to finance a new enterprise as opposed to borrow or issue equity. This tax advantage for debt can actually, depending on where interest rates and inflation are and so on, can get you a negative user cost for 100% debt financed investment, which maybe at times we want because we think that if investment is going too slow because people are too cautious or something. But when the tax code encourages firms to be heavily debt laden, then if their plans fail a little bit, they have negative surprises on profits. Well, then all of a sudden the bondholders are lining up, throwing them into bankruptcy, and trying to get their cash out. And so I think economists generally view that as one of the larger problems with the corporate tax code.
Well, Dr. Gravelle, you mentioned in discussing one of the possible impacts of lowering the corporate tax rate of discouraging debt flows.
Right. That just shows that there's never an easy answer to anything, because it is true that our favoritism of debt causes all the things that Kevin mentioned. They can also have adverse effects for the flow of capital, because debt is far more substitutable across countries than equity. And there were a couple of Treasury researchers who looked at this effect of debt, and they concluded that if you lowered the corporate tax rate, you would actually reduce the flow of capital in the United States. So it makes it difficult to decide what to do about debt, because on the one hand it's causing this debt equity distortion, on the other hand it might be attracting capital from abroad. So